What's up? I'm Dan Friedenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Friedenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Friedenberg, and that there is a commercial real estate building.
I'm joined today with Victor, and is it Menasce? Is that a good guess?
Victor Menasce.
Menasce. Okay, cool, good. And I got great news for you today, Victor. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Is because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, private passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, why are you doing that? And the answer is, if you've ever heard of private off-market deals, sometimes they're called 506B deals, you're not allowed to publicly discuss them unless you've got documentation of your prior substantive relationship. Or else the SEC might get ants in their pants and they might take away your business in the form of rescission. That's bad. So I have people on here and we talk about what's your core competency you're going to contribute, what's your buy box, who you're looking for, and all that kind of fun stuff. But the benefit to you is you're going to learn to more effectively communicate on the subject of commercial real estate deals, and you'll understand how my guest fits into those deals. But before we get too excited about real estate specifically, Victor, do you want to introduce yourself a little bit?
Well, Dan, great to be here, and thanks for having me. So I'm, like yourself, based in the nation's capital in Canada, just outside the Ottawa area, and our firm is Y Street Capital. We're based primarily in the U.S. We're active in both U.S. and Canada, and we're active in 9 states. We're primarily new construction, new development, and we do everything from small bay industrial to industrial outdoor storage, multifamily apartment new construction, senior housing, and we do a fair bit of land development as well. We've got a few thousand acres of land under development across right now 9 states in the U.S.
Excellent. I love it. I love it. And that brings me to the first segment of this show, which I call the 5 distinct motivations. Now, before I do that, Victor, I don't know your level of technical acumen, but I was wondering if I gotta say, but wait, check your aid. Can you try to look through your camera and into the user's device? Down there might be this big, hideous subscribe button, and maybe they should do something about that. Okay, it's not so subtle and it's kind of a dumb joke, but whatever. I do it in every episode. Let's talk motivations. Everybody has their own unique why, and you need to have a lot of motivation to stay in this industry, so it's important to know what it is. But even though everybody's reason for continuing or making their next acquisition is unique, I find they fit pretty neatly into these 5 different categories. And so this is how we know that my guest isn't going to throw in the towel when the going gets tough. The first motivation of the 5 is preservation of purchasing power. This tends to apply mostly to people who either they are work optional, so they don't have to make an acquisition every 10 seconds, so to speak. They don't have to do deals just for deal's sake, or they are basically high income earners, and so there's a portion of their income they need to make sure that that nest egg doesn't dwindle away in the form of inflation. The reason why people will make acquisitions if they're in this situation is if inflation is eating away at the purchasing power of the cash flow from their portfolio, then it's going to be time to make another acquisition. The other one is if there's an asset crash or any way that you can get the steepest discount possible on your next acquisition, that will be enough to motivate people like this to make their next move, whereas regular people, they'll have to be a little bit more proactive. And full disclosure, I'm not to this point in my real estate career. What describes me better is trading time directly for wealth. I was chasing the bigger salary, the the higher income through tech. My background is in the CRM industry and being a full stack developer, and so that's how I found my way to real estate. Mostly because I had a boss who was flipping 10 houses a month. He was doing 10 single family transactions per month, and I started to realize that, hey, I seem to be on the wrong side of the right business, and so I stopped trying to get the highly taxable, higher wage, higher salary, and started going for equity. So that's what I'm up to, but I get that that is a little bit subtle, especially for youngsters. What tends to resonate with them a little bit more is they want to fast track retirement by hustling like crazy right now, or perhaps they just want to take control of their schedule, and that is a perfectly fine motivation. The only place where I find that a mistake comes up when people tend to have this as their primary motivation is they think that everybody is secretly trying to retire, and that's simply not the case. The fact is there are plenty of people that have lots of reasons to hustle into their 90s. The first one is plain old ambition. They just want to buy their entire hometown. They want to make sure that their great grandchildren never have to hold a day job, and that's why they're going to be hustling into their 90s. And I get that this sort of mentality, it's actually vilified in some circles, but the fact is, if you're a resident or even if you're a business owner and you're leasing property, you're going to need somebody who's not going to be asleep at the wheel, someone who's actually making a difference, being proactive and making the place nicer so that it makes more sense to stay there or rent there than somewhere else. Now, of course, the fifth and final motivation I have here, these 5 categories, they're also going to be hustling into their 90s, but it's not so much that they want for their own legacy or anything like that. Maybe they've picked a different group of society. Maybe it's the environment. Maybe it's animals. They've got some impact group that they want to make a big difference on, and they found out that there's a financial component, so they figured, hey, I'm going to have to get some sort of vehicle to build wealth to make that impact, and so they chose commercial real estate. So Victor, of those 5 different categories, what combination of those would you say describes you best?
Well, I'd say I don't know. It cuts across several of them. I mean, from my standpoint, and when I say me, I really mean we. It's really about our organization, not just myself. Our focus is on fundamentally creating value, and the business is all about solving problems that are acute enough that people are willing to pay money to have solved, and then the next question is, are they going to buy it from you? So, we're not into the flipping game or anything like that. We're really about creating value. And that can be done many different ways. It can be taking a piece of raw land that at the end of the day, dirt is dirt, but the way it's valued is a function of what you can do with it. Farmland might be 3,000 an acre. Many parts of the country, you put a 40-story building on it, and now it's in the millions per acre, but it's all the same dirt. So, of course, it's got to satisfy the laws of supply and demand. But entitlement is a big piece of creating value when it comes to land, and we really view the entire landscape as opportunities to create value. Whether it is a multifamily apartment building, it's not just a bunch of 1 and 2 bedroom units. It's who's the customer, and what are they looking for? Are is the customer, are they students, or are they older adults that are downsizing from detached homes? Those are different products. Or if you're designing a 2-bedroom unit, is a 2-bedroom 1-bath or 2-bedroom 2-bath? That's a different product and a different customer. So it really comes down to figuring out what is the need in that hyper-local market context, and then building that. So for example, today we have a project that we're building, 252 suites just on the edge of a ski resort north of Montreal. And it's workforce housing because if you're willing to spend $400 a night, lots of place for you to live. But if you are fitting ski boots, or you're a ski instructor, or you are serving cappuccinos, there's nowhere for you to live. And so we're solving those types of problems.
I love it. I love it. And of course, one of the things you did a great job, Victor, of keeping it really grounded. But a lot of people, when we're talking about motivation, they start to sound a little bit starry-eyed, even possibly bordering on naive. And one way that I tend to taper that, just using with the format of this interview, is I go straight to the tolerance for risk assessment. Now, if you've ever been involved in an off-market deal, whoever the securities attorney in the mix, and there really should have been one, whoever they were, they should have insisted that every investor, every partner should have filled out what's called a suitability questionnaire. And it has all sorts of heavily invasive financial questions like what's your net worth, what's your income, how long have you been investing, and that sort of thing. Now, when I was filling out one of these suitability questionnaires, though, I found one question in particular problematic because I felt that even it didn't matter which of the multiple choice answers you chose, it didn't give me an answer that I thought you could really take to the bank. It really lacked utility. So for this interview, I made up my own one, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Victor, it could be inside real estate, it could be outside real estate. You can give one of each if you want. What's too risky for you to invest in?
Um, I would say crypto is one that I would say is too risky because the value, the notion of value is, I don't get it. And by the way, I come from a tech background, so I can tell you exactly, how the underlying technology works. But what I'm having trouble with is understanding the actual notion of value. And that's probably the number one, because it's based on scarcity, and that notion of scarcity is actually somewhat artificial. It's arbitrary. That's number one. But in real estate, I would say I would stay away from office today because even with people returning to office and post-pandemic, the demand for office space is shrinking. There's no question about it. You see firms all over the country shrinking their office footprints, and you can have a vacancy in an apartment and you can fill it next month. If you have vacancy in office, that could be vacant for a long, long, long time until you find that perfect tenant. And if you do find that perfect tenant, there'll be a ton of rent concessions and so on, especially in today's environment. So that would be my answer to that question.
And I love that answer, right? And quite frankly, one of the things that I love when you're talking to somebody with a lot more experience is that I don't feel bad when I might be asking a question that's a little bit more on the difficult side. And for the first 1 or 200 of these chance encounters, I actually skipped this next question because I thought that there are some people who are more like PR or marketing, front of house, that sort of thing, and they're not the type of person who's going to do a deep dive into a spreadsheet, really get the meaning from underwriting. And so it's kind of not fair to be talking about deal metrics in great detail. However, at the end of the day, in real estate, we're all in the business of deploying capital. We're all in the business of curating deals. In other words, finding the ones that we're going to be a part of and avoiding the ones that aren't so good. And so it hit me that everybody's going to at least know a few different deal metrics, and they're going to rely on them more than others. And so I asked for the favorite, like a top 3 or something like that. And for everybody in the audience who's only listening and they're not watching, I read this list out here. There's 14 here. It's not an exhaustive list, but that way you can follow along at home that way. The first metric I have here is cash on cash. The second one is IRR, which is internal rate of return. It's also commonly known as an equity multiple. In other words, how much more, how many times your initial investment are you going to wind up as far as a projection goes. Then you've got the cost per door. You've got the net operating income of the property. You've got the going in cap rate. That's because generally in the United States, the standard or the going cap rate is published through different brokerages and things like that. And so it's a really fast back of the envelope way to find out what kind of discount you're getting on the property by looking at the going in cap rate. Then you've got the loan interest rate, which is particularly interesting for people who are going to be assuming loans. You have the occupancy rate. Of course, the occupancy is the inverse of the vacancy rate, so it's the same number but just inverted. But that one is ultra important. Next, we've got the average income where the property is located. We got the amortization period of the loan, which of course that's going to be especially important if you're assuming a loan as well. Then there's the market versus in-place rents. What's the difference between those two, so you can figure out how much room there is to add value, what the market can bear. Then there's the population growth where the property is located, and the idea of population growth is that you've got increased demand because more people are there with who need a place to live. Then we've got the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now. There's the waterfall split or exit strategy, which is basically talking about what's going to happen to your investment after your principal has been returned. Basically, are you going to have to look for another deal? Are they looking to sell the property? And that's how it completes. What does it look like that? And then the last one I have here is DSCR, which is debt service coverage ratio, which is talking about how much of the revenue from rents and whatnot is basically going out the door immediately just to pay for the loan. Now, Victor, of course, I mentioned that this isn't an exhaustive list, but do you want to give some of your top three or something like that?
Yeah, what we tend to focus on, we're about value creation. So it doesn't matter whether you're looking at a value add deal of an existing project or you're looking to build something new. I actually want to see a profit margin, which is not really on your list. And there's several different ways that you can articulate that. One way is to measure the difference between the yield on cost on your project compared with the market cap rate, so that you need a spread between those two numbers. And that's an indication, you're going to build it for 10 million, but it's worth 14. Okay, so you've got a 40% margin. Those are the types we want to see that spread. And you can express it as a difference in value, as a profit margin, or you can measure it as a difference in cap rate, which is the reciprocal. But either way, you're looking for that margin. At the end of the day, it's really about satisfying the laws of supply and demand. And it's one of those laws that if you choose to ignore it or violate it, it's like gravity. It's going to hurt. So you really want to be paying very close attention to that. And it's not just looking at it from a short-term perspective. You want to be looking at that over a sustained time period. Some people are looking at, they might have, a short-term rental or something, and they say, oh, the numbers are great, but the barrier to entry is low. And so eventually that market will saturate until nobody's making any money if the numbers are great. So you really want to understand the laws of supply and demand, not just at a snapshot in time, but over time.
I love that answer. You look like you were going to continue, though. Was there another metric, or are you good with that?
I mean, we could talk about this in many different segments,
Right.
but those are the fundamentals.
All right, I love it. I'm just gobbling up that answer like a delicious subscribe sandwich. Is that intense enough for you? It's a great little reminder. It tells me it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different main roles in a commercial real estate deal. And I go through all 6 sides in every episode of Chance Encounters. The idea being is I think it really is the linchpin in helping you effectively communicate on the subject of a commercial real estate deal and understand not only all the pieces of a major team, but also how my guest fits into those deals. And as I'm going through this, if you're sitting there thinking, I need to get me one of those cubes because I want to show it to my friends and my family and all that kind of stuff. Well, the great news is it's absolutely free. You go to dandoesdeals.com right up there, and then you will see this great big button where you can click it and download it and print it out and fold it up yourself. But let's get started, and I'm going to start first by talking about repositioners. Repositioners are the most public-facing people in a real estate deal. In general, they're looking at a whole whack of different properties. They're underwriting the deal. They're called repositioners because they're figuring out, how am I going to change how this property is run to find more upside? They have to look through and do the underwriting, do the arithmetic, do the math, because of course you also have to find out if the broker or seller is even telling the truth about how much the property is making right now. That's a huge thing. But I'd say the most confusing part when you're first coming into this industry about the repositioners is, why do they have to focus on investor relations and have this wide network of financiers? Now, of course, financiers are not involved in running the actual deal. They interact with the owners. They deal with paperwork and capital, in other words, loans. So they can be banks, they can be private investors, all that sort of stuff. And the reason why repositioners have to have a vast investor network or financier network is because if you can secure a cheaper loan, that's going to go straight to the profitability of the building. So that is a huge piece of the puzzle. Now, of course, course, everybody is in the industry of deploying capital, so that's why that's so important and why repositioners tend to be so well networked in those groups. But of course, the next place a repositioner is going to take a look is they're going to take a look at the operations, find out where the Benjamins are going down the toilet, and put a stop to that. Now, of course, there's much more to operations than just unclogging toilets and mowing lawns and collecting rents. Me personally, because I'm from the internet, I end up helping in a marketing perspective in the sense of if somebody, even if you are dealing with bigger properties like I tend to focus on, which is 100 units or more, usually in that case you're going to be outsourcing to a third-party property manager, so there's not going to be too much for you to do as far as asset management goes. But if you've got a vacancy rate problem, if there are a lot of empty units, somebody on the GP team is going to have some marketing chops to get those units filled. And then of course just my technical background and automation and all that kind of stuff contributes as well. So that's the hat I tend to wear in a GP situation. But of course there's only so much you can do in operations to find that upside. So the next place that the repositioner is going to look is to get the contractor team involved to renovate the place, make it nicer so that future residents, people who rent the place in the future, they'll be happy to pay more in rent than the current or past ones because it's a nicer place. But if only things were that easy. The fact is you can go ahead and spend endless money on a contractor team and doing these upgrades. You can gold plate the toilets, but it's not going to translate to a return on investment. And if you're like me, once again, I'm from the internet. That means I'm going to need locals. I'm going to need boots on the ground who can go check in on how the construction projects, the renovations are doing, make sure that the operators are actually doing what they say they are. They're not sloughing photographs and all that kind of stuff. So you're going to have somebody who's going to be there in an hour or two. And unless you're talking about in the Ottawa area, that's not going to be me. So of course, those are the pieces of the local puzzle. But to explain the sixth piece of the puzzle, I like to use a little bit of a hypothetical. Let's say you're an engineer or a physician or an attorney or something like that, and maybe you already have your own, like a portfolio of rentals. Maybe you have some single family, some Airbnb, something like that. So you get the idea in your head saying, hey, I know that I just come up with the deposit and then I borrow the rest. I bet if I turn around to my colleagues at the hospital or at the law firm or something like that, we each pool maybe $100K each or something like that, we could take over that 350 unit apartment complex down the road. So full of confidence, you turn around to the banks, you say, hey, I've got my deposit and I've got proof that I can run the place. You got, say, tens of millions of dollars you want to lend me to take over that huge property over there? Well, they're going to pour some cold water on your head right there because they're going to ask you, who's the sponsor? Who's the KP? What's that all about? So if you want to be eligible for a commercial loan, somebody in the fold has to already own a similar asset. So in other words, you're not going to get approved for a commercial loan on a 350 unit apartment complex unless somebody in the fold already owns a 350 unit apartment complex. On top of that, you need operating capital and you need the collateral, in other words, balance sheet available among the GP team worth at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Victor, I understand that in many ways you are the sponsor KP. I'm sure you also have significant repositioner jobs, and of course everybody has some financier relations because we're all really deploying capital. But which of those roles do you tend to focus on?
Well, I would say we're pretty vertically integrated, so we by necessity play in all six of those, probably a few more as well. When if you think about our largest project, which today is just under 1,800 acres on the edge of Colorado Springs, that's an entire master plan community that will eventually, be several thousand rooftops. So there's a development of a complete infrastructure. There's all of the utilities, the development of the utilities, the arterial roads, much of the public infrastructure needs to go into that. So there's many facets even over and above what you talked about there, because at the end of the day, we actually need a very strong both design and engineering component in order to come up with a concept that is going to be financially viable, that is going to be accepted by the community, is going to be not just accepted, but actually meet the commercial demand. So it's all of those things, and that's part of what we do and part of our fiduciary responsibility to our investors.
Perfect. So let's talk about buy box. You mentioned a few different markets, but just so that you're understanding when real estate people ask each other, hey, what's your buy box? What's your ideal property? What are you looking for? We're asking for three main things. First one's geography. Where is it? Which state? Which county? Possibly even which neighborhood? It's going to matter before you call it ideal. Now, the second one is size. Now, if you're talking about residential, like multifamily, usually they go off a unit count. In other words, the number of apartment units to figure out the size. The reason why size is relevant is because the type of team that will regularly take over 5 or 10 unit apartment complexes, they'll be fundamentally different from the ones that are taking over 150, 250 unit apartment complexes and whatnot. Now, of course, as Victor was mentioning, there are many different types of commercial real estate. Some of them go off of acreage, some go off of square footage. There's the unit count as well, but the size concern will still remain. The third one I call desirability. In the industry, it's generally called class. I don't like the term class because it's actually two things, not just one. And those are the condition of the property and the area where the property is located. If you're talking about condition, we're talking how beat up is the place, how recently renovated is the place, what sort of amenities go along with it, like swimming pools, hot tubs, exercise gyms, all that sort of stuff. And then when you're talking about the area, if you're talking residential, the school districts where the property is located, that's going to be important. The crime rate always matters for every type of property. But if you go back to that old broker trope of location, 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 I'm not a fan of it because I think what they really mean is traffic, traffic, traffic. If there's a gazillion people passing by a property every single day, it's going to have more implicit value than a place where it's basically crickets. But both the area and the condition are ranked the same way as in grade school, where you've got A plus at the top, and then A, and then A minus, and then B plus, and so on. So, Victor, I get that you're pretty diversified among different types of property, but where's the sweet spot right now?
We're seeing a number of opportunities, in particular in light industrial. We're seeing that if you think about large bay industrial, I think a lot of that right now is saturated. There was a lot of new product that came into the market. The segment that seems to be underserviced right now is small bay industrial. And that's a place that we're making significant investments ourselves. We are active in a new segment, relatively new segment called industrial outdoor storage. So this is taking land that is zoned light industrial and building smaller storage yards specifically for contractors, folks that, if they want to buy, let's say, landscaping material by the truckload, they want a place to store that in exchange for that 15-20% discount buying by the truckload, but it needs to be secured. It needs to have proper lighting, security cameras, electricity, all of the things that a contractor needs, the right turning radius to get equipment in and out of there, because you're not parking your bulldozer in your residential driveway. It's got to go somewhere else. So, we're very active in that space, and there are many communities around North America that, quite frankly, have failed to zone enough land industrial. So that's a product that's in extremely high demand. We still love a lot, multifamily apartments. There's been a lot of new product injected into the market over the last couple of years, especially at the tail end of the pandemic. So many markets are saturated today. Even some of the fastest growing markets, I'm thinking Austin, Texas, Nashville, Tennessee, are saturated today. But there are select segments in the market that we think make a lot of sense. We're active in the active adult space, which is a segment that is between a market rate apartment and independent living. So it's towards that age restricted end of the spectrum, but very highly amenitized. And so the rents in that space are filling a gap between a market rate apartment and independent living, but you're not necessarily offering all of the different services that you would see in independent living, or AL for that matter, assisted living. And we have built assisted living and memory care, so we're active in that space as well. So it really It depends on the specific market. It's like you said, it's always hyper local. And so, if folks want to connect, then we'd be happy to chat with them more about, what we're doing and what might be a fit for their portfolio.
The perfect segue, because that's what I'm going to talk about next. Is I'm going to talk about people. It's who is out there in the audience who is perfect to interact with. And the fact is that real estate, especially commercial real estate, it's a much more social industry than, say, technology, where my background came from. And it's absolutely fantastic. People are really eager to give referrals, build new teams, even if they're not going to be involved in them themselves. But of course, all of us have our own unique skill sets, which makes us better suited for helping some people more than others. Now, of course, as I mentioned already, this is an extremely capital intensive industry. So, of course, everybody is going to be interested in meeting more passive investors. Me personally, though, I find that I need to find more sponsors and KPs than anybody else. And the reason for that, there's a couple of them. One is because I'm from the internet, and that's the brand of help that I end up putting out. But the other one is because I've been automating and helping teams get more done in a shorter amount of time for so long that I can make a bigger impact with a group that's already got some sort of foundation than just some startup where everybody has to be putting in 80 hours a week or whatever. That's great for those people, but it's not where I'm making my biggest impact personally. So I'm always eager to speak to sponsors and KPs. Victor, I know you've got a 506c deal, at least one going on right now, so you can mention that. But who's out there in the audience that you're best suited to help?
Well, we work with a number of passive investors, both in the US and Canada. We have projects on both sides of the border. What's interesting right now, quite frankly, is that the US dollar has fallen in value. It's down at least 10% since the beginning of the year. And while the administration, the White House, is aiming to do a lot of good things for the US economy, right now the US dollar is taking a significant hit. Interest rates in the US are much higher than they are in Canada. I mean, the Fed funds rate is 4.25. The yield on the 10-year Treasury is also in that 4.2 range. And so the borrowing costs in the US are significantly higher than they are in Canada. The equivalent, if I look at the 5-year Canada mortgage bond rate, it's today trading at about 3.11. So interest rates in Canada, if I want to build a new apartment building in Canada, I can probably get that priced under 4%. You're not getting that in the States. In the US, interest rates are running on commercial real estate are running in the mid sixes. Maybe if you can get a HUD loan, a HUD 221D4 or a 223F, you might get it around 575 on the best day ever. But that's significantly higher interest rates. So, we have a number of US investors that are investing in our Canadian projects, and it provides a little bit of diversity. Some people are a little worried about investing internationally because they're worried about, is it going to be tax efficient? Our CPAs have guided us with a structure that we believe is tax efficient. So maybe that's something to look at.
I love that answer. And so I'm sure people are just dying to find out, how do I reach out to Victor? But I'm going to sandbag that and talk about myself for a second. I'm fortunate enough to have this super duper distinct last name that you can see down here. So I'm really easy to find on LinkedIn, which is the social media platform where I spend most of my time. Of course, you can find other episodes of Chance Encounters like this on dandoesdeals.com. It's a little bit difficult to read. The QR code, just so you know, that actually goes to the Amazon author page that I have available to anybody out there. You can check out the different books that I have on different skill building topics and that sort of thing. Now, of course, if you are involved if you enjoy playing chess or that sort of thing, you want to appear on one of my podcasts, then connecting through LinkedIn is the best way to do that for sure. But Victor, if people want to reach out to you, so social media, email, website, what's the best way to reach out?
Well, our company is ystreetcapital.com. So the letter Y, streetcapital.com, all one long word. And you can click on the investor page and register to join our investor portal. We promise we're not going to spam you with all kinds of stuff, but you'll get a chance to see the projects that we have underway within the company across a wide range of both asset classes and geography. And then we'd be happy to further the conversation. If there's a fit, then we can take the discussion deeper.
Perfect, perfect. And that brings me to my public service announcement. So it's not so much for you, Victor, as you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's just down there. You probably haven't hit it yet. I know that you gotta look out for that, because if you have kids around, they'll judge you. They'll be like, I thought I knew you, all that kind of stuff. You should know that hitting subscribe is completely free. All it means is that my videos might show up on your list of suggestions, which you can feel free to ignore, because quite frankly, I just appreciate the fact that you spent this time with me. Just like Victor, I appreciate you joining me. This has been great.
Thank you, Dan.
All right, awesome. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.